Hello, everyone, and welcome to today's episode of Macro Microscope. This is the March 2025 edition. Today's topic is country rotation in financial markets. I am Indrani Day, Head of Global Investment Research at FTSE Russell, the index business of London Stock Exchange Group, and I'm joined by John Dioufas, Director, Data Stream and Macroeconomics at the London Stock Exchange Group. As always, a quick disclaimer. FTSE Russell is not an investment advisor, and everything said in this presentation is purely for educational purposes. Now, before we jump into the story of the rotation, country rotation, let's give a little background to it. So, what this chart is talking about is the exceptional outperformance of United States equities over the rest of the world. We are using the FTSE indices. So you see in the post 2010, the chart on the right shows the ratio of FTSE United States relative to the all world ex United States. And you see that the FTSE US returned more than 3 times the all world ex US since 2010. This analysis is done in a paper called Decomposition of US Equity Returns, and you can look it up, the link at the bottom, but it's data through end of 2024. And a little more deep dive into what caused this exceptional outperformance. We kind of break up the returns each year starting 2003 till 2024 into the three components: earnings growth, valuation changes, and the dividend yield. Look at the chart on the right. For the in the interest of time, what I want to point out is if you break it into two time periods, the 2003 to 2010 and the 2011 onwards, the returns of the Russell 1000 on an annualized basis almost doubled from north of 7 percentage points to north of 13 percentage points. But you see that the earnings growth picked up just a little more from the pre-period to the post-period. Most of that, extremely high annualized returns, the share of the valuation expansion was much higher in this post 2010 period. And with that, we jump into this, this whole story of rotation, that 2025 has been really unique. What is happening in equity markets? You're seeing shifts in the equity market leadership. Now, US equities started underperforming in January, and its global peers continued into February, whereas European equities are really shining. This is all numbers through end of February, but the story continues in March. Essentially, year to date, the United States equities have been lagging the all world ex United States. And who's really outperforming? It's China, it's developed Europe, it's United Kingdom. And those of us who saw our past episodes over last year, we often talked about that other countries are playing catch up to the United States equity, closing the gap. And now that catch up story has moved into a rotation story. So that is what is really interesting. And you see that we have the returns of the different parts of the world over different time periods, 1 month, year to date, 12 months. And you see the story, now being fairly consistent. Even on a 12-month basis through February, it's China and UK equities outperforming the US. So what has been happening in 2025 is really quite remarkable. And the chart on the left hand side, I want to show for a very long time, people wrote off European equities. They were not performing relatively that well compared to the United States. The chart on the left shows on a month to month basis, each gray line is one of the years since 2001, how European equities are doing relative to the US equities. And you see the blue line for 2025, sharply up, Europe outperforming. And this is the best outperformance since 2001. Now, having said all this, what are the reasons? Some reasons commonly talked about is, of course, the high policy uncertainty emanating from the United States, China's DeepSeek model, which kind of shook up the AI tech story. But I would like to lay out another real macro story to it. On the right hand side, what you see is how different equity markets, the US large cap, small cap, all world, ex United States, and emerging markets perform under different real rate regimes. These are the real rates on the US 7 to 10-year treasury, the benchmark, the foundation for the whole global financial system, so to say. And you see that US equities really outperform in a regime where real rates are less than 1 percentage point. Not surprising given that US markets are, growth oriented, tech oriented, things like that. around 1 to 2 percentage points is when the rest of the world kind of plays catch up. And when it's more than 2 percentage points, real rates are quite high. The rest of the world equity performance tends to be higher. And it so happens that today we are at a point of real rates just around 2 percentage points. And I'll just end by saying what I talked about was in equity markets, but we are also seeing many major currencies gaining versus the US dollar in February, something slightly unusual because generally in risk aversion terms, the dollar strengthens. And with that, let me turn it over to John, who will take us deeper through this.
For the 14th of Jan this year, in the lead up to the inauguration of a new president and a new administration coming into Washington, we see that that's where the green line, which shows you the US dollar index, declined quite. That's where its decline kind of started. It sort of gained momentum at that point. We see that yen strengthened significantly from about 160 down to 147.82. We also see a nice pickup in the euro dollar and also in sterling. And people wonder why that is. Now, there's a couple of stories there. One is, of course, that people are sort of looking to invest in other markets, in the equity markets, but that's a story that's happened more recently than the 14th of January this year. I think what really happened, where we're starting to see a lot of evidence coming out, is a lot of US producers were expecting there to be a lot of truth to the stories of tariffs, right? And it started front-loading, buying as much of the raw materials as they needed in advance of any potential tariffs being implemented. So, of course, there was a lot of importing of steel and aluminium into the US economy, which, of course, means that needs to get paid for. So there was an outflow of dollars. But I think there is also a story there that has to do with what are people's perceptions around the dollar, and what we see sort of leading up to 2020, 21, 22, the start of 22, we see always that the dollar index followed the US Fed funds targets rate, right? After 2022, with inflation kicking in, we see a bit of a disconnect where really there was negative correlation between the Fed funds target rate and the US dollar index. And then what we see again after the 14th of January, this time correctly labeled as 2025, we see that even though the Fed has sort of kept interest rates a little bit, there's been a little bit of easing, but sort of moving more sideways than anything else, we see this dramatic drop in the dollar index. And basically what we're saying is there's a sentiment change that's taking place in the markets. And that is shown over here. I'm going to finish off today's conversation with this slide here that basically is showing the complete disconnection has taken place between all the various central banks. They're following their own monetary policy. There is no longer really tied to what is happening to the dollar as much as what is happening within their own economies. So they are pivoting for growth. They are not that worried about inflation. They are more worried about what they need to do to make their market succeed. And we're seeing a lot of investment funds flowing into the European equity markets. Thank you very much, everybody. Have a good day. Bye-bye.
And that brings us to the end of today's episode, Country Rotation in Financial Markets. Thank you so much.